Howdy, everybody. I'm Raymond Dahlman. This is the Liberty Call for Tuesday, January 11th, 2022. Hope everyone's having a fantastic day out there in the interwebs. It's another beautiful day here in Colorado along the Front Range out in the middle of nowhere. We got sunny, clear blue skies, still a little snow on the front, on my front yard just because it doesn't get any sunlight. So still got, I don't know, there's probably a couple inches still out there that haven't melted away. But yeah, if you go further east from where I'm at, it's basically all brown again. So if it's your first time watching or listening, be sure to like, subscribe, and share. And, kind of a boring day. The market was, not too bad. Looks like as the market came to a close, it looks like things were up for the day. So, yesterday kind of sucked. Today looks a little bit better, just with all the, bad news that's out there. I think that's really causing a lot of, consternation and worry unnecessarily. So, all right, well, let's go ahead and jump into the week or into the numbers and take a look and see. The Dow Jones was up 0.51 to close at 36,252. The S&P 500 was up 0.92, closed at 4713. NASDAQ was up 1.41, closing at 15,153. Small caps were up 0.91. The VIX dropped 5.10 down to 18.41. So across domestically, it looks pretty good. Looking at my charts earlier, it looked like the Dow transports and utilities were in the red. I'm not sure if they got back into the green before the close. Across Europe, I see quite a bit of green, no reds across the board. And then when we get down to the Asian markets, they were in the red. It looks like the Hang Seng finished at 0.03 down, and the worst was the SZSE component at down 1.27. So, looking across the globe overnight, Asian markets were down, European markets were up, and we finished up for the day. So again, not too terrible, but, we'll keep an eye on, the VIX, as long as it stays under 20, I feel pretty good. Once it starts getting up into the 20s and near 30, that's the time to start putting on your emergency gear and getting ready for whatever the future holds for us. So, all right. Well, I have a couple articles I want to read through today. These were most of these I think were found on Yahoo Finance. So I figure if I'm looking at them, you're probably reading them too. So, all right. First one, Fed Chairman, if we have to raise interest rates more over time, we will. This is written by Brian Chung. And let's go ahead and breeze through this quick article. Federal Reserve Chairman Jerome Powell told Congress Tuesday that if the pace of price increases do not come down, the central bank will get more aggressive with raising short-term borrowing costs. If we see inflation persisting at high levels longer than expected, if we have to raise interest rates more over time, then we will, Powell said in a Senate Banking Committee hearing. Powell is facing the Senate for his renomination. President Joe Biden announced in November that he will be tapping Powell for a second term at the helm of the central bank, with current federal governor Lael Brainard serving as vice chair. Her confirmation hearing is scheduled for Thursday. Stakes are high for the Fed this year, with inflationary prints showing prices rising at a clip of almost 7% on a year-over-year basis. The Fed has spent the last year or so trying to figure out how much those price increases are due to rising demand, which allows producers to raise prices, or constrained supply, in which COVID disruptions increase the cost of production inputs. Powell said both appear to be contributing to high inflation, but the Fed chief acknowledges that demand is very strong at the moment. The Fed's most potent tool The Fed's most potent tool remains interest rates, which the central bank has pinned to zero since the depths of the pandemic. Raising interest rates could address higher demand by making it more expensive to borrow, but higher borrowing costs would likely not do too much to address supply issues like shipping bottlenecks at the world's ports. We can affect the demand side. We can't affect the supply side, but this is really a combination of the two, Powell said. All right. Fed watchers say the central bank is moving quickly to pull forward its efforts to undo its pandemic era easing money policies. In addition to keeping zero interest rates, the central bank has absorbed trillions in U.S. treasuries and agency mortgage-backed securities. This so-called quantitative easing program has served as a messaging device to markets on its intention to keep policies accommodative. In the face of inflation, the Fed now has plans on ending its program earlier than expected. The Fed will then look to raising interest rates. For the Fed, which also prioritizes the health of the labor market, a continued pace of monthly job increases has given policymakers confidence that they can tighten policies without disrupting hiring. It really is time for us to begin moving away from those emergency pandemic settings to a more normal level. It really should have not have negative effects on the employment market, Powell said. Powell's expecting to sail through confirmation, which will involve vetting by the Senate Banking Committee, followed by a full floor vote from the 100-member Senate. Powell has had a record of securing bipartisan support through several administrations. A Republican by affiliation, Powell was confirmed by the federal board as governor during the Obama administration, securing 71 to 21 vote in 2012 when Trump was tapped to Powell to replace Janet Yellen as the head of the Fed. Powell easily won confirmation by 84-13. So, going back up here where he's talking about, interest rates, raising interest rates could address higher demand, but higher borrowing costs, the shipping bottlenecks. I mean, realistically, keeping interest rates, I'm sorry, let me start over. They said that, the zero interest rate policy really began at the beginning of this pandemic 2 years ago. I'm sorry, that's BS. The zero interest rate environment has been going on for more than a decade, going back to the last financial crisis back in 08 and 09. So, yes, interest rates did start to creep up in, 2018, 2019. And then, the markets, threw a fit, and, the president at the time, President Cheeto, put pressure on Powell to to lower the interest rates again, so that hopefully he could have gotten reelected, which it didn't happen. I mean, I don't care either way. I hate both parties. I think they're all scumbags. But anyways, so we'll see. We've talked about this before on many of previous recordings where, in the late 70s, early 80s, interest rates had to get jacked up into the high teens to squash the inflation we were seeing at the time. I'm not sure how, raising rates to, even 2% in the next, say 24 months is really going to put much of a dent in the inflation we're seeing right now. All right. Next article, if we're lucky, the Fed can engineer a soft landing. Expect more than 4 interest rate increases in 2022 and a lot of market volatility, says JPMorgan's Jamie Dimon. This was written by Mark DeCambray. Hey, there's Mr. Dimon. I worked for him a long time ago, back in my when I lived in San Antonio, worked for Chase. All right, let's dive into this. CEO Jamie Dimon says the consumer remains in great shape in 2022, but also concedes volatility could be elevated in financial markets as the Federal Reserve aims to navigate a COVID-induced surge in inflation. During a CNBC interview on Monday afternoon at a healthcare conference hosted by his bank, the U.S.'s largest by market capitalization, the CEO said market projections for as many as 3 rate increases could be very easy for the economy and the market to absorb, but he says he expects that the central bank might aim to do more. I'd personally be surprised if it was just 4 interest rate hikes. Jamie Dimon's comments came as the market was spiraling lower earlier Monday, and as economists at Goldman Sachs said they expect 4 rate increases in 2022 versus a previous call for just 3. And a Fed balance sheet runoff that begins in the third quarter as early as July. Economists at Deutsche Bank expect 4 rate hikes in 2022, starting in March, roughly in line with the market's expectations, researchers wrote in a Monday note. For his part, Dimon said that he was hopeful that the central bank can help ease inflation pressures. If we're lucky, we can engineer a slowdown and you'll see inflation come down and we'll have what you'll call a soft landing. He says presentingly, the consumer balance sheet has never been in better shape, and that he expects the best growth we've seen that we've ever had this year. He said, "I think since maybe sometime after the Great Depression. So Mr. Diamond seems to think that we're going to have a better growth and economy coming out of this than we did after the Great Depression. We'll see. Meanwhile, a downturn in equity markets has taken its toll, particularly in the NASDAQ, which is largely comprised of rate sensitive technology and growth stocks, has cooled somewhat. The Dow Jones, which was down by nearly 600 points at its session low, was off by 200 in afternoon trading. That was yesterday's market. So evidently, I mean, Mr. Diamond is confident, or at least that's what he's saying, that we will be able to navigate this and not have some sort of a financial meltdown or a currency problem. I personally think we're going to crash and burn. But I mean, and the reason I say that is I worked for the government for 4 years as a sailor, back almost 30 years ago. The government doesn't do anything well. It's full of village idiots and retards who hold on to their jobs for life because they know they can't make it in the private sector. And if you think, I have to imagine it's the same way all the way up. I mean, there's nothing that our government has done in the last 2 decades that I've been working in the private sector that gives me any confidence that they're going to navigate this in a way that's going to have a smooth or soft landing. So, I mean, I could be completely wrong, and I'll be the first to admit that, if the Biden administration and the Federal Reserve and the powers that be manage to get a year from now, we have no major market recession or corrections, and the dollar is stronger than it is today. I'll eat my hat, and you're welcome to call me out on it, but. I got 47 years of watching what's been going on, and I have no faith that these idiots are going to, take care of us in a proper way. So, all right, last article here: 6 surprising facts about retirement. This comes from Investopedia, written by Troy Siegel. And this was updated today, yesterday, the 10th of January. All right. Retirement is a topic that regularly makes headlines, and not all of them are encouraging. Americans are living longer than before. However, if you assume most people are saving more to prepare for their longer term needs, you be mistaken. Here are some of the most startling truths about retirement in the United States. And before I even go into this, I can say beyond a shadow of a doubt, most people are just cruising through life, have no clue, what they're going to need for the years that that they either can't work or choose not to work. And I think most of them have no idea how expensive it is for healthcare costs, for just budgeting, long term for the future. So, when I was in, working for a branch office, in Houston, the area I was in was a very, well-to-do area where, NASA was right there. And you would just be surprised at the amount of engineers and scientists who I sat down with for, initial interviews to see if, they were interested in my services. And it was just shocking at how little people who were making $100,000 to $200,000 a year as a household in a fairly inexpensive. It's not super cheap to live there, but compared to the rest of the country, up until recently, you could buy a home for under $200,000 in that area, and it may not be the super nicest one. The nicest ones were going for $400,000 or $500,000, but you could get a very nice house in a well-to-do neighborhood, and for a very reasonable price. And most of these people were just pissing away all their money. So it was just it was kind of disheartening as a young advisor, 15 years ago, that most people didn't prepare for the future. So, all right, number 1, it could last longer than you think. In a 2021 survey, the actual mean retirement age for retirees is 62. And according to the Centers for Disease Control and Prevention, the current life expectancy is nearly 79. However, for many, retirement will last much longer than 17 years. The numbers are skewed by the number of individuals who die relatively young. Considering this, a 65-year-old woman has a 50% chance of making it to age 86 and a half. And a 65-year-old man has a 50% chance of reaching age 84 as of January of 2022. That's why younger workers need to plan for 2 decades or more of income in retirement. And for current retirees, the ultra-conservative portfolio composed of solely bonds may not provide enough growth, especially with interest rates still at historic lows. While portfolios exclusively or primarily composed of bonds may seem safe than stocks with potentially lower downside risk short term, historically they provide a significantly lower overall returns long term. This can be cause for great concern in regarding to keeping up with inflation and meeting desired asset projections for satisfactory income later. All right, Social Security number 2. Social Security falls short. Yeah, anyone who's trying to live solely on Social Security knows that it does not go very far. One of the biggest issues with Social Security is that it only provides a similar standard of living for those living in for those in the lowest quartile of income earners in the United States. In other words, unless your household is earning less than $30,000 a year, most people will need to rely on some sort of personal savings in order to maintain their current standard of living in retirement. And I think the thing that bothers me the most about Social Security is that you're paying a portion of it and your employer is paying a portion of it. And it comes out to about 13, 14% of your wages on the first, 120,000. And so basically for, 90% of Americans, who are making under 100K, or maybe not 9, maybe 80% of Americans, you're putting, 13, 14% into the Social Security system. I mean, what are you really getting out of it? I mean, the income that's provided is terrible. I talked about either last week or maybe yesterday, talking about the Social Security situation, and the return on investment is just awful. So, I mean, personally, I hope that it falls apart sooner than later. I don't know what we're going to do for the people who are already on those incomes. I don't know if we'll do it at the state level or maybe a county level, but I mean, the federal level is just garbage. So, the sooner that falls apart, the better. Americans are way behind on savings. Hey, what was I just talking about? Between 2 stock market crashes and not saving enough in the last 16 years, coupled with increased expenses and inflation, Americans are far behind on saving for retirement. As the American workplace turns away from pension plans, the onus is increasingly on workers to secure their own retirements. A Price Waterhouse Coopers report shows that the median retirement savings for individuals aged 55 to 64 is only $120,000. For those 35 to 44, it's $37,000. So, I mean, personally, I recommend, if you're starting out young, just to sock away, 25%, just put 25% aside, as life gets more expensive, you might have to dip into that or use some of that for, insurance or disability or other things to protect your nest egg. But, unfortunately, most people live hand to mouth. And I mean, hey, I was there 20 years ago. I know what it was like, being in my mid 20s and, having a family. And, unfortunately, sometimes you got to borrow some money or use a credit card to pay for things. But the sooner you can start, segregating a portion of your income for the future, the better off you're going to be. All right. Many still lack a retirement plan. Duh. It used to be that you could spend most of your career at one company and count on a pension once you reach retirement. The median private pension and annual benefit is now only $10,788. Unfortunately, many Americans aren't replacing those pensions with a defined contribution plan, such as a 401k. In 2020, there were 60 million active 401k participants, while the workforce included 162 million people, roughly meaning 37% of individuals are actively participating in their company retirement plan. Again, not good. Staying in the workforce. Given the fact that so many Americans are behind on their savings, perhaps it's not surprising that they remain in the workforce well after reaching Social Security eligibility. However, one key issue for many older people who are interested in working to supplement their Social Security is that they may not be able to find a job. Notably, after coronavirus pandemic, the average unemployment rate for those 65 and older was 7.5%. In 2020, the highest ever. Individuals aged 65 and older with a job fell 12.9% from February 2020 to February of 2022. 6, Medicare won't cover assisted living. Government data reveals that nearly 70% of individuals who reach age 65 will need long-term care at some point. The median cost of assisted living facility was $4,300 a month as of 2020, according to Genworth Financial. It has more than twice that for a private room in a nursing home. While many seniors don't realize that Medicare doesn't pay for most long-term care costs, it only covers 100 days of care at a skilled nursing facility, and only if it was preceded by a hospital stay of 3 days or more. If you're not sitting on a sizable nest egg, that's a good reason to start thinking about long-term care insurance in your late 50s or early 60s. All right. So all good things. I know that retirement is sometimes a scary thing. I mean, for myself, I plan on doing something until the day I croak, or at least until I'm not able anymore. But that's just me. I hate sitting around idle. I'm always, even when I'm sitting around just listening to a podcast or sitting out back staring at the mountains, I'm always thinking of something. I'm, if you could listen to the voices in my head, they're just going, 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 going. But anyways, as far as planning for retirement and having enough money to make it through the end, I remember a conversation with my grandfather. This was when my son was really or the youngest boy was really little. He was probably under 2 or 3, and me and my granddad were just sitting around talking, and at the time he was probably in his probably the late 90s, early 2000s. So he probably was in his early 70s. And at the time, he says, "Gosh, I didn't think I was going to live this long," because he was already collecting his pension from his employer. And he said, "Well, if I known I was going to live this long, hell, I would have taken the higher payment rather than the spousal. Because if you have a pension payment that covers your spouse, also you get a lesser amount because you're covering 2 lives." And he wound up living, until 2014. So more than another decade beyond that he and his wife, or my grandmother, were both 84 when they passed. So, you know, I mean, these were people who smoked their whole lives. They drank a ton of beer. I mean, they lived a hard life and still made it to their mid 80s. And, like I said, really it's just a little bit of planning. What I try to tell people is, there's 8,700 hours in a year. If you can't give me 3 hours to plan for the future, there's really not much I can do for you. So, all right. Well, that's everything I had for today. I only managed to ramble for 22 minutes. I'm doing much better. Let's see. Looks like a couple of people watching online. Let me see if there's any comments in here. Nope, don't see any comments. And if anyone needs anything from me, don't hesitate to shoot me an email or drop me a phone call. Smoke signals are always good. It's a nice, clear day. I should be able to see them from many miles away. So hope everyone has a great evening, and I will be back tomorrow. Have a good one. Bye.